Welcome to this month's Market Update. I'm joined today by Casey Lowe, Senior Consultant with Frontier Advisors, Capital Markets and Asset Allocation Team. Hi there, Casey.
Wayne?
Well, it's certainly been a busy month for central banks around the world. Take us through some of the highlights in their responses in the last month.
It has been busy, so quite a number of central banks have continued to increase interest rates around the world. The US Federal Reserve, the UK's Bank of England, the European Central Bank, and they've all been increasing. Even the Bank of Japan have slightly tightened their policy as well, so they've adjusted the yield curve controls, although their cash rate is still pretty much near 0%. So still very different from other regions, but they are tightening a bit as well. Specifically, look at the US, the US Federal Reserve have continued to hike their cash rate, so it's in the range of 5.25 to 5.5% now. So above where the Aussie cash rate is. Taking a bit of a different approach is the Reserve Bank of Australia, where the cash rate was left on hold at the August meeting. So this is the second consecutive month where the left rate unchanged.
And so what's driving that difference of the view from the RBA here in Australia?
Very much for the same reasons that we've spoken about in previous videos. One thing is that they want more time to assess the impact of the rate hikes that have already happened already. So they've increased the cash rate by 4%. They want to see the impact flow through the economy. But the other bit is that inflation is moderating now in Australia. So that's given them a bit of comfort to take a wait and see approach. But having said that, they have continued to emphasize in their announcement that further interest rate hikes may be required. So they are still on the tightening bias, as they would say. But if we look at inflation in US as a guide, it should be that Australian inflation should also continue to moderate from here. But we still think the risk is that it may stay stickier than what the central bank would be comfortable with, partly because our labor market is still very strong, so that should add to inflation, but also that the house prices have started to increase again. So again, that should also put pressure on inflation too. So market expectations wise, because of this pause in the cash rate and also inflation, because inflation is moderating now, market expectations have adjusted downwards. So it's now expecting one more rate hike to come through later this year. So this is an adjustment downwards from last month where markets were expecting two more hikes to occur.
So let's turn our gaze now towards China, obviously one of the largest economies in the world and one that has a huge impact on the Australian economy. But step us through some of the current signals and sentiment coming out of China.
So the US economy has been very resilient as of late. China has been the opposite. The Chinese economy has been pretty weak. When we look across the economy, when we look at trade, the exports and imports data have been particularly weak. It's actually registering negative annual growth right now, so it's declining. And if we look at demand, one indicator for that is looking at the inflation rate there. They're actually experiencing a slight deflationary pressure. So the latest reading there is minus 0.3%. So price levels are falling now and showing you that domestic demand in China is actually quite weak. One sector which is particularly important is the property sector in China. That also looks particularly weak. When we look at housing construction activity there, it's declining. When we look at the number of housing transactions taking place, that is still at a very depressed level, still below the levels that we've seen in previous years, which goes to show that confidence in the housing sector is very low there. There's been some policy response so far, but I would say most of it have been marginal, so we don't think it will have a significant impact. Our view is that for China to recover more strongly, there probably needs to be policy support that will give confidence in the property sector in China, particularly because right now households are unwilling to buy new houses because they're just not sure which property developer are going to go under. So we need policy response that will help boost demand or confidence in the housing sector then.
So lots for investors to monitor. Thanks for your insights today, Casey. And thanks for watching this month's Market Update.